Huysamer Capital Investments was registered as an asset manager in 2003. The Huysamer brand started when George Huysamer established his stockbroking firm in 1964. The business grew to become one of the top 10 stockbroking businesses with an extensive presence in South Africa and Namibia. Now, Wynand van Niekerk, CIO at Huysamer Capital Investments, joins us from our Cape Town studio to share their investment strategy. Good evening to you, Wynand, and looking through the notes that you sent us on Huysamer Capital and also Citadel, where there's a link, I saw the word value and long-term and 20 years. So perhaps you'd just like to set out the stall, as it were, for how you go about things.
Yeah, good evening, David. We basically want to talk about the philosophy and how we see long-term investments. At Huysamer Capital, we've basically got a strong value bias, but we're not a value manager as in the traditional sense. So,
right, so how would you kick off, and particularly in the present environment, obviously you have to think long-term as well as short-term, but what is your thinking at the moment given the global environment and the market environment?
Yeah, that's why if you can put that first slide on, I would like to talk about it. Is it possible?
I think they have it here. That's the GDP growth as opposed to after-tax profits. That was your slide.
Oh, that's the one, yeah.
Well, there it is now. It's up on the screen. Yes, talk to it, Wynand.
Okay, so if you look at this graph, this is only from 1984. But if you look at the South African nominal GDP, I just divided by 25 to bring it in line with the all-share index. That's that black line. If you look over a 50-year plus period, that line, the nominal GDP, not the real GDP, the nominal GDP is actually increasing year by year on average by 13.5%. If you look from 1994 onwards, you get an average of about 11.5%. And if you look currently with a low inflation, if inflation is going to stay in this band, you're probably going to look at 10.5% on average. But what's important is to see how smooth this line is. It's actually very smooth, and it actually never went negative over this whole 50-year plus period. Then if you look at the after-tax profits of the all-share index, that is the blue line, you can see these businesses sometimes get headwinds and sometimes they get tailwinds, but all in all, it follows the same growth as the nominal GDP. And then when we go to the red line, which is the all-share index without the dividends, you see it's more volatile than the earnings, and it's much more volatile than the nominal GDP, but over time, the index are rising by the same rate. So from all the average businesses will follow this 10.5%. And what we are looking for is businesses that do better and has got better competitive advantages, and that's the ones that we want to invest in when they are under pressure.
Wynand, Wayne, yeah, I'm old
Yes,
enough
Wayne.
to remember George Huysamer quite well, and Dion.
Yes.
But to come to the question I want to ask, if you look at your methodology there, which is something I totally and utterly support, with one slight proviso, the real, or one of the major factors that has changed in the South African investment environment over the last 30 years is bond rates have gone from 15% to 8%. So when I look at markets, I do a very similar thing to you. I look at GDP or some sort of economic indicator, but then I adjust it for the difference in the bond rates, because in theory, the share market is earnings or economic activity discounted at a particular rate. So any particular reason why you don't take the SA GDP or some economic indicator and make an adjustment for the quite dramatic alteration in the risk-free rate over that time period?
Okay, that's the next slide. If you can go to the next slide. Can you put up the next slide? It's on there.
Here we are.
It's up.
It's up, yeah.
Okay, what you see there is what Wayne is talking about. That blue line is the All-B bond index. So if you invest in an average business or in the all-share index, you want actually, because it's in equities and it's quite risky, you want to put on a 60% risk premium on top of the all bond index. So say the all bond index is doing 10%, you're looking at 16% return. If the all bond index is doing like 7%, you must take 60% of the 7%. So you're looking at around 11%.
Does that answer the question?
Have you got it, Wayne?
Yeah. No, I get that.
You understand?
Now, Wynand, sorry.
If you look at...
Go for it, Wayne. Ask the question. Hang on, Wynand. We keep banging like railway trucks.
It's a bit of a problem with
Wayne, you start.
Cape Town. Wynand, when you look at a true value investor, would you go out and buy resource shares now at 7.5 PEs, which are very, very low by historical standards for these companies?
Yes, we actually have done them. If you look at the fact sheet that you've got there, we've got the resource shares already in there. They offer very good value at the moment.
And perhaps be more specific. We can't look at the fact sheet on the screen, Wynand, so you can tell us about it. But if you look at platinum, has been very much in the news. So on the one hand, we've got the big diversified miners at PEs of 7, BHP Billiton and Anglo on the one hand. And there you have to take a view on what their long-term prospects are. The other one, of course, is the platinum sector. And a lot of people in the studio here in the evenings and the mornings have been saying it's time to talk about whether it's the bottom of the platinum market. So it may or may not be, but that's how people are thinking. And if you believe that ever platinum is going to be in demand again, and you have a company like Amplats which is battled but has good assets and is generally well run and so on, is it time to buy platinum? So how would that fit into the philosophy you've just told us? And you talked earlier about looking for companies where that kind of value is available.
Yeah, in terms of that Citadel portfolio, we basically invested in 3 resource shares. The first one is Sasol. We've got an 8% weighting. We've got BHP Billiton at the 6% weighting, and we've got Implats at a 5% weighting. How we try to structure the portfolio for the long term, because this is 3 to 5 year portfolios, you will find that 30% of the fund will be in these deep value businesses, and they're getting more deep value, as you know, in Implats. Then the other 40%, we've got the value shares who are starting to perform. I'm talking the things that were value that's now performing. Things like British American Tobacco, we've got 10%. MTN is 7%. Standard Bank, we've got 8%. And Richmond, we've got 6%. So that's another 40%. So 70% of the fund is value buyers. Then 30% of the fund is business that we bought but are performing well, and it's quite expensive. There I'm talking about things like Aspen, Shoprite, Mediclinic, Tiger Brands, Naspers, and SA Brews. So that's the basic structure of the fund. 70% is value buyers, and then 70% is performing, because there's an overlap of 40% in the middle.
Wynand, when you look at the general investor market out there, do you find people are buying into equity funds, or are they a little bit cautious? Are they taking money overseas, or are they bringing it back? What are the general trends in the retail market that you're experiencing now? Yeah,
I think it's a very good thing to diversify overseas, but we're seeing very good inflows into these domestic funds at the moment, because it's long term and you can actually capture the value when these good businesses are under pressure.
Wynand, you mentioned BAT earlier, and I think you had a graph. If we've got that graph, we can put it up and you can talk to that. I think it was the third one in your presentation. But while we think about that, Sasol, you did mention Sasol earlier, and we had a discussion a little earlier about the opportunities possibly for Sasol in the United States, where they've got all this gas, and what the phrase Wayne used was as much gas in America as the Saudis have oil at the moment. And of course, there's still a lot of coal in the world, and Sasol's proprietary technology means it's well placed for that. So oil and gas, gas to liquids, coal to liquids for Sasol. Where would they sit? Because it's the sort of share that you could say is fully priced, or it follows the oil price, but it's unique, Sasol, as a share.
I totally agree. I think Sasol is one of the most misunderstood businesses as a business, because people trade it on the oil price and on the exchange rate. But if you look at the competitive advantages of Sasol, Jannie Maton always says, just give me opportunities. Now, if there's a business that got opportunity, it's Sasol. They basically spending capital of around 18 billion rand a year. But they get opportunities of 3 times that. They basically work on a hurdle rate where they know that they're going to get a certain return on their capital. And they implement only a third of those opportunities. So they're taking the top third best opportunities, and that is already 18 billion rand. The big benefit in Sasol is that they've got the clean fuel. If you look at sulfur, the points per million, if you go to Japan, it's less than 100. If you go to Europe, it's less than 100. If you go to like something in America, it's around 400, 500. If you go to third world countries, it's above 1,000. So at some stage, the world will recognize this Fischer-Tropsch process that they're using, where they convert coal to gas, coal to liquid, and gas to liquid, is one of the most cleanest processes around.